What if I told you that a conflict happening literally thousands of miles away in West Asia is the exact reason why your personal monthly budget feels so tight right now? I mean, it sounds kind of crazy to connect a distant geopolitical event directly to your wallet, right? But just a few hours ago, the Reserve Bank of India made a massive announcement that proves exactly how interconnected our money really is. Welcome to The Explainer. I'm stepping in as your financial advisor today, and we're going to break down how global tensions are basically dictating the rules of your personal finances.
Okay, let's dive right into this by asking the huge question that is probably on your mind right now. Why on earth isn't your home loan EMI dropping? Or actually, on the flip side, why are the high interest rates you're getting on your bank fixed deposits stubbornly refusing to budge? Listen, if you've been sitting around waiting for loans to get cheaper before buying that house, or maybe upgrading your car, well, the rules of the game just changed. We're going to look at why the RBI made a really high-stakes move recently and exactly what it means for your money as a retail investor.
So here's our quick roadmap for today's explainer. First, the boss bank's thermostat. Second, war, oil, and your groceries. Third, building a financial fortress. Fourth, high EMIs, home buyer reality. And finally, number 5, the golden window for savers. All right, let's kick things off with part 1, the boss bank's thermostat.
5.25%. The RBI recently concluded its highly anticipated Monetary Policy Committee meeting, and Governor Sanjay Malhotra delivered that exact headline. The committee unanimously voted to keep India's benchmark interest rate frozen at exactly 5.25%. They're basically maintaining what they call a neutral stance, just waiting to see which way the economic wind blows. Now, okay, to most people, central bankers sitting in a room talking about percentages sounds incredibly boring, right? But this single decision absolutely dictates the cost of your credit cards, your home loan, and the profit on your savings. So what does this percentage actually represent?
Well, that percentage is the repo rate. Think of the RBI as the ultimate boss bank, or, the bank for banks. When regular commercial banks like SBI or HDFC need a short-term loan, they borrow money from the RBI. The interest rate the RBI charges them, that's the repo rate. Think of it like running a small business. If your wholesale supplier raises their prices, you're forced to charge your customers more, right? If the RBI gives loans to banks at a high repo rate, those banks pass that extra cost right down to you, raising the interest on your loans. The RBI literally uses this like a giant economic thermostat. If the economy is sluggish, they drop the rate to heat things up. But if spending is way too high and prices shoot up, causing inflation, they raise that repo rate to cool things down.
Which brings us to part 2, war, oil, and your groceries. So, if the thermostat is steady right now, why did the tone of the RBI suddenly change from confident to incredibly cautious? Well, it's because the global landscape outside our borders has suddenly become a minefield, particularly with the escalating geopolitical tensions in West Asia involving Iran. And this exposes our massive economic vulnerability. India imports more than 80% of its crude oil. 80%. That is absolutely huge. When international oil prices swing wildly because of Middle Eastern conflict, India has to spend significantly more money just to keep its factories running and vehicles moving across the country.
And this builds into a really dangerous step-by-step domino effect. Step 1, we have the geopolitical conflict. That leads directly into Step 2, a global oil shock with spiking crude prices. Because fuel is suddenly way more expensive, we hit Step 3, transportation costs rise dramatically. And finally, Step 4, the trucks carrying your vegetables, your milk, and your clothes, they cost more to run, which means the final price tag on your local groceries goes straight up.
In economics, this devastating chain reaction actually has a specific name: imported inflation. It's a general rise in prices triggered not by what's happening inside our own borders, but by an increase in the cost of imported products, in this case, crude oil. You are essentially paying for a global crisis right at your local supermarket checkout.
Because of these oil supply shockwaves, the RBI aggressively revised its retail inflation forecast for the upcoming financial year up to 5.1%. And get this, they warned it could hit nearly 6% by the third quarter. That is dangerously close to their upper comfort limit, forcing them to act defensively just to protect your purchasing power.
And that leads us right into part 3, building a financial fortress.
You see, inflation isn't the only headache here. When global investors get scared of war, they panic. They pull their money out of developing markets like India to buy perceived safe haven assets, usually US dollars, which weakens the rupee. This illustrates the tough trade-off the RBI faced. They chose the shield of economic stability over rapid growth. Because of this double whammy of rising inflation and a sweating currency, they actually cut India's expected GDP growth forecast for the year down to 6.6%, just to weather this global storm. Governor Malhotra noted that, hey, while our internal economy is rock solid, we simply cannot ignore these outside forces.
So, to fight back, the RBI launched a series of tactical financial maneuvers to build a literal fortress around the economy. They didn't just hold interest rates, they liberalized rules to attract foreign portfolio investors, making it way easier for global money to buy Indian government bonds. They also simplified Indian equity investing for non-resident Indians. By rolling out the red carpet for foreign dollars, the RBI pulled off a massive win. Immediately after, the rupee rallied strongly, posting its biggest single-day gain in over 2 months.
Okay, Part 4. High EMIs and the home buyer reality. So what does all this macroeconomic drama mean for you on a micro level? Well, if you have an existing floating rate home loan, or maybe you plan to buy real estate soon, your monthly EMIs are staying exactly where they are. No immediate relief is coming, guys. If you are hoping to sign a new home loan contract expecting rates to magically fall by Diwali, you really need to rethink your timeline. Top economists are actually predicting that the RBI might be forced to raise interest rates later this year if global oil prices don't cool down. Borrowing costs are going to remain high and sticky. But conversely, if you're a saver, the story is completely different.
Which brings us to our final section, Part 5, the golden window for savers.
Because the RBI is keeping the repo rate high, commercial banks are desperate to lock in your money so they can continue to hand out expensive loans. As your financial advisor today, my highly prescriptive advice is this: do not let your surplus cash just sit idle in a savings account, earning a miserable 3%. We are in a golden window right now. Lock that cash into a high-yield fixed deposit before the economic cycle turns. Banks are currently offering highly attractive returns hovering between 7 to 8% for senior citizens. It's a no-brainer.
Ultimately, keeping rates high is the RBI's way of placing a deliberate protective shield over your household budget. It's a strategic move to stop prices from just spiraling totally out of control. It basically means that while your loan isn't getting cheaper anytime soon, your monthly grocery bill shouldn't get drastically more expensive either. The RBI is choosing stability over reckless speed.
It just goes to show that in a highly globalized world, your wallet is deeply, deeply connected to everything happening on the world stage. With fixed deposit rates peaking and home loans basically staying flat, I want to leave you with this to reflect on. Are you going to use this time to lock in safe savings, or are you holding off on buying your dream property? Think about your personal financial strategy, and let me know your thoughts in the comments below. See you in the next explainer.